Right now, as you're watching this, money is being reinvented. The dollar bills in your wallet, the numbers in your bank account, even the way governments control currency. All of it is transforming before our eyes. Central banks worldwide are racing to launch digital currencies that could replace cash entirely. China is already testing theirs with millions of users. The Federal Reserve is researching its own version. Meanwhile, cryptocurrencies are challenging the very idea of who should control money. This isn't some distant future scenario. It's happening now, and it will fundamentally change how you save, spend, and build wealth. For thousands of years, money evolved slowly. We went from bartering goods to using gold coins, then paper currency, and eventually digital banking. But each transition took centuries. Today, we're witnessing a financial revolution that's unfolding in mere years, not generations. The COVID-19 pandemic accelerated changes that were already brewing beneath the surface. Physical cash usage plummeted as people avoided touching bills and coins. Governments injected trillions into economies through digital transfers. Banks closed branches while fintech apps exploded in popularity. Traditional financial institutions suddenly looked outdated compared to platforms that could move money instantly, globally, and with minimal fees. But this transformation goes far deeper than convenience. We're seeing a fundamental power shift in who controls money and how it flows through society. Central banks, once content to work behind the scenes, are now developing digital currencies that could give them unprecedented visibility into every transaction. Private cryptocurrencies promise freedom from government control, but come with their own risks and volatility. Traditional banks are fighting to remain relevant while tech giants like Apple, Google, and Amazon push deeper into financial services. International trade is being reshaped as countries explore alternatives to the dollar-dominated system. The question isn't whether money will change. It already is. The question is whether you'll understand these changes well enough to protect your financial future and potentially benefit from the opportunities they create. The death of cash and the digital currency race. Walk into any major city today and you'll encounter businesses that no longer accept cash. Coffee shops, restaurants, parking meters, even street vendors have gone digital only. In Sweden, cash transactions now account for less than 10% of all payments, and some bank branches don't even handle physical currency anymore. China's urban centers have become virtually cashless societies where even elderly street vendors accept payments through smartphone apps. This isn't just about convenience. It represents a fundamental restructuring of the monetary system, and governments are watching carefully because they recognize both the opportunities and the threats this presents. The decline of physical cash creates a vacuum that various players are racing to fill. Central banks watched nervously as private companies and cryptocurrencies began capturing the digital payment space. Facebook's announcement of Libra, later renamed Diem, particularly alarmed monetary authorities because it threatened to create a private global currency outside government control. Even though that project ultimately failed, it accelerated something that had been moving slowly through bureaucratic channels for years. Central banks realized they needed their own digital currencies or risk losing monetary sovereignty to private corporations and decentralized cryptocurrencies. China moved first and moved aggressively. The digital yuan, officially called the Digital Currency Electronic Payment System, launched pilot programs in major cities in 2020. Unlike cryptocurrencies, the digital yuan is completely centralized and controlled by the People's Bank of China. Every transaction is visible to authorities. The government can program the currency with expiration dates to encourage spending, restrict where it can be used, and potentially even freeze individual accounts instantly without involving banks as intermediaries. By mid-2023, over 260 million digital yuan wallets had been opened, with transactions exceeding 100 billion yuan. China isn't just testing a new payment system. It's building infrastructure that could fundamentally change the relationship between citizens, commerce, and state power. The European Central Bank responded with plans for a digital euro, emphasizing privacy protections that distinguish it from China's approach. The Bank of England, Bank of Japan, and dozens of other central banks launched their own research and pilot programs. According to the Atlantic Council's CBDC tracker, over 130 countries representing 98% of global GDP are now exploring central bank digital currencies. More than a dozen countries have already launched them, mostly smaller nations using CBDCs to improve financial inclusion and reduce dependence on foreign currencies. But the real game changer will be when major reserve currency nations fully deploy their digital currencies. The Federal Reserve has been more cautious than its counterparts. America's existing payment infrastructure, while not as advanced as China's mobile payment systems, is more developed than many countries. The dollar's position as the world's primary reserve currency means the Fed has less urgency to innovate. However, research continues. In 2023, the Fed launched a pilot program called FedNow for instant payments between banks, laying potential groundwork for a future digital dollar. Treasury officials have repeatedly stated that any American CBDC would need to protect privacy while preventing illicit finance, a balance that's technically challenging to achieve. The implications of CBDCs extend far beyond payment convenience. These digital currencies would give central banks direct insight into economic activity in real time, potentially allowing for more responsive monetary policy. During economic downturns, governments could instantly distribute stimulus payments to every citizen's digital wallet without waiting for checks to be printed and mailed or relying on banking intermediaries. They could implement negative interest rates more effectively by making it impossible to hoard cash. They could automatically collect taxes on every transaction. They could enforce sanctions with precision, freezing the digital assets of specific individuals or organizations instantly. But these capabilities that governments view as features look like surveillance risks to many citizens and privacy advocates. A society without cash is a society where every purchase is recorded and potentially monitored. The power to program money means authorities could theoretically restrict what you can buy or how long you have to spend your money before it expires. The infrastructure for financial surveillance would be complete and permanent. As we race toward this digital future, we're not just changing how money works. We're fundamentally altering the relationship between individual financial freedom and state control, often without full public debate about the trade-offs we're accepting. Cryptocurrency and the decentralization dream. While governments race to digitize their currencies under centralized control, a parallel revolution has been unfolding with the opposite philosophy. Cryptocurrencies emerged from a deep distrust of traditional financial institutions and government monetary policy. Bitcoin's anonymous creator, writing under the pseudonym Satoshi Nakamoto, released the Bitcoin white paper in 2008, just as the global financial crisis exposed catastrophic failures in the banking system. The timing wasn't coincidental. Bitcoin's Genesis block, the first block in its blockchain, contained a message referencing a newspaper headline about bank bailouts, making the political statement explicit. This was an attempt to create money that no government or institution could control, inflate, or confiscate. Bitcoin's rise from essentially worthless digital tokens to assets worth tens of thousands of dollars each represents one of the most extraordinary financial stories of our time. Early adopters who bought or mined Bitcoin when it was worth pennies became millionaires, sometimes billionaires. The cryptocurrency attracted libertarians who saw it as freedom from government monetary control, technologists fascinated by blockchain innovation, speculators hoping to get rich quick, and eventually institutional investors looking for portfolio diversification. By 2021, Bitcoin's total market capitalization exceeded $1 trillion. Major corporations added it to their balance sheets. El Salvador even adopted it as legal tender alongside the US dollar. But Bitcoin's journey has been anything but smooth. Its price has experienced multiple boom and bust cycles, dropping by 80% or more multiple times only to recover and reach new highs. Each cycle brought predictions of Bitcoin's death from skeptics and renewed conviction from believers. Critics pointed to its volatility, its use in criminal activities like ransomware payments and dark web marketplaces, its massive energy consumption from mining operations, and the fact that most people held it as a speculative investment rather than using it as actual currency. Supporters countered that volatility would decrease as adoption increased, that the US dollar also facilitates crime, that Bitcoin mining increasingly uses renewable energy, and that digital gold was a perfectly valid use case, even if it wasn't used for daily transactions. Ethereum, launched in 2015, expanded cryptocurrency's ambitions beyond just money. Its blockchain could execute smart contracts, self-enforcing agreements written in code that automatically execute when conditions are met. This opened possibilities for decentralized finance, or DeFi, where people could lend, borrow, trade, and earn interest on crypto assets without banks or traditional financial intermediaries. At its peak, over $100 billion was locked in DeFi protocols. Users could earn yields far exceeding anything traditional banks offered, though with significantly higher risks. The promise was compelling, a complete parallel financial system running on transparent code, rather than opaque institutions, accessible to anyone with an internet connection, regardless of their country or credit history. Then came the crashes and scandals that reminded everyone that decentralization doesn't eliminate risk or greed. In 2022, the cryptocurrency market experienced a brutal collapse. Bitcoin fell from nearly $70,000 to below $16,000. Multiple cryptocurrency lending platforms froze withdrawals and declared bankruptcy, trapping billions in customer funds. The Terra Luna stablecoin ecosystem, which had grown to a $60 billion market cap, collapsed completely in a matter of days, wiping out fortunes and triggering a cascade of failures across the industry. The bankruptcy of cryptocurrency exchange FTX and the criminal conviction of its founder Sam Bankman-Fried for fraud revealed that many cryptocurrency companies operated with the same reckless practices and lack of oversight as the worst of traditional finance. These failures damaged cryptocurrency's credibility but didn't kill it. Bitcoin recovered, as it had after previous crashes. Regulatory clarity slowly improved as governments worldwide developed frameworks for digital assets. In 2024, the United States approved Bitcoin exchange-traded funds, allowing mainstream investors easy access through traditional brokerage accounts. These ETFs attracted tens of billions in investment within months, suggesting that institutional adoption was accelerating despite the industry's troubled recent past. The question remains whether cryptocurrencies represent the future of money or merely a speculative asset class. Can decentralized currencies coexist with government digital currencies, or will one prevail? Will blockchain technology transform finance, or will it remain a niche innovation? The answers will depend partly on technology and economics, but mostly on a more fundamental question about what kind of financial system we want. Do we value the transparency and control that centralized government currencies offer, or the privacy and autonomy that decentralized alternatives promise? The infrastructure war, banks, tech giants, and fintech. The transformation of money isn't just about new forms of currency. It's about who controls the infrastructure that moves money through society. Traditional banks have held this privileged position for centuries, serving as the intermediaries through which nearly all financial transactions flowed. They made money from this position through fees, interest rate spreads, and the float from holding customer deposits. But their dominance is being challenged from multiple directions simultaneously, creating a competitive landscape that would have been unimaginable 20 years ago. Fintech companies struck first, identifying pain points in traditional banking and building specialized solutions. PayPal made online payments simple at a time when typing credit card numbers into websites felt risky. Venmo turned peer-to-peer payments into a social experience. TransferWise, now called Wise, slashed the cost of international money transfers that banks charged exorbitant fees to process. Robinhood eliminated trading commissions and made investing accessible through a smartphone app. Each of these companies took a specific function that banks performed poorly or expensively and built a better, cheaper alternative. Individually, they were niche players. Collectively, they were death by 1,000 cuts. The real threat to traditional banking, however, came from tech giants who weren't content to take small slices of the financial pie. These companies already had hundreds of millions or billions of customers, sophisticated technology infrastructure, mountains of consumer data, and brand trust that many banks would envy. Apple introduced Apple Pay, turning iPhones into payment devices and inserting itself as an intermediary between customers and their banks. Google followed with Google Pay. Amazon built a lending business to finance marketplace sellers, using transaction data to assess creditworthiness more effectively than traditional credit scores could. These companies weren't trying to become banks. They were building something potentially more powerful. platforms that made banks into commoditized service providers hidden behind superior user interfaces. China's tech giants moved even more aggressively. Alipay and WeChat Pay didn't just facilitate payments. They became the entire financial ecosystem for hundreds of millions of Chinese consumers. Users could pay bills, invest in money market funds, buy insurance, take out loans, and manage their complete financial lives without ever opening a traditional banking app. These platforms process trillions of dollars in transactions annually. At their peak before regulatory crackdowns began in 2020, Ant Group, which operates Alipay, was valued at over $300 billion, more than the largest American banks. Chinese regulators eventually intervened, concerned that these companies had become too powerful and systemically important, but the damage to traditional banking's monopoly was already done. Banks haven't taken these challenges lying down, but their responses reveal the difficulty of competing against digital native companies. They've invested billions in digital transformation, building mobile apps and online services to match fintech convenience. They've acquired fintech startups to acquire technology and talent faster than they could develop internally. They've partnered with tech companies even as those same companies competed against them. JP Chase spends over $15 billion annually on technology, employing more software engineers than many tech companies. Yet for all this investment, banks remain constrained by legacy systems, regulatory compliance costs, and organizational cultures built around branch networks and personal relationships rather than algorithmic efficiency. The regulatory environment complicates this competitive landscape. Banks operate under extensive regulations covering capital requirements, consumer protection, anti-money laundering, and dozens of other areas. These rules exist for good reasons. They help prevent the kind of catastrophic failures that triggered the 2008 financial crisis. But they also create compliance costs and operational restrictions that non-bank competitors don't face. A fintech app can launch in months with minimal regulatory oversight. A bank needs years and millions in legal and compliance costs to launch similar products. This regulatory asymmetry advantages new entrants. Though as fintech companies grow larger, regulators increasingly apply banking rules to them, leveling the playing field somewhat. The infrastructure war is also playing out in the background systems that make payments work. Credit card networks like Visa and MasterCard process trillions in transactions annually, taking a small percentage of each one. They've maintained this position through network effects. Consumers want cards that work everywhere, and merchants accept cards that consumers carry, but new payment rails threaten their dominance. Real-time payment systems are being built in countries worldwide, allowing instant bank-to-bank transfers that bypass card networks entirely. Cryptocurrencies promise to eliminate intermediaries completely. The companies that control how money moves through society in 2040 may be completely different from today's dominant players. The geopolitical chess game and your financial future. The transformation of money isn't merely a technological or economic story. It's fundamentally a geopolitical power struggle, with consequences that will shape international relations for decades. The US dollar's position as the world's reserve currency has given America extraordinary advantages. Countries hold dollars as reserves, creating constant demand regardless of US economic fundamentals. International trade, especially in oil and commodities, is primarily conducted in dollars, forcing even countries with no American trade to acquire dollars. This demand allows the US to borrow cheaply and run sustained trade deficits that would cripple other nations. Perhaps most powerfully, dollar dominance makes American financial sanctions devastating, since being cut off from dollar-based international payment systems can paralyze a country's economy. Many nations have grown resentful of this arrangement, particularly after witnessing how the US weaponized the financial system. When Russia invaded Ukraine in 2022, Western nations didn't just impose trade restrictions. They froze Russian central bank reserves held in dollars and euros, ejected Russian banks from SWIFT, the international payment messaging system, and essentially cut Russia off from the global financial system. These sanctions were economically devastating for Russia, but they sent shockwaves through capitals worldwide. If America and its allies could freeze the assets of a major nation and exile it from the financial system, couldn't they do that to any country? China, with nearly $3 trillion in foreign reserves, took special notice. The search for alternatives has accelerated dramatically. China and Russia increasingly conduct bilateral trade in their own currencies rather than dollars. The BRICS nations, Brazil, Russia, India, China, and South Africa, recently expanded to include several other countries, have discussed creating alternative payment systems and potentially a common currency, though significant obstacles remain. China has promoted its cross-border interbank payment system as an alternative to SWIFT, though it remains far smaller. Saudi Arabia, long a cornerstone of the petrodollar system, has entertained proposals to accept Chinese yuan for oil sales. These aren't yet existential threats to dollar dominance, but they represent cracks in a system that seemed unassailable 20 years ago. Central bank digital currencies add a new dimension to this geopolitical competition. China's digital yuan isn't just for domestic use. It's designed to facilitate international trade and could provide an alternative to dollar-based payment systems. If Chinese companies can pay for imports using digital yuan, and exporters can accept it knowing they can easily convert it or use it for their own purchases, the need for dollars in international trade diminishes. China has piloted cross-border digital currency transactions with Thailand, the UAE, and Hong Kong. The Belt and Road Initiative, China's massive international infrastructure program, could become a vehicle for promoting digital yuan adoption across dozens of countries. The implications for ordinary people might not be immediately obvious, but they're profound. The financial system you navigate today offers certain freedoms and faces certain restrictions based on the existing global order. If that order shifts, your access to international markets, the stability of your currency, the effectiveness of your savings and investments, and even your ability to move money across borders could change dramatically. A more fragmented international monetary system might reduce American power, but also increase currency volatility and transaction costs for everyone. Multiple competing currency blocks could make international trade and travel more complicated. The transition period could be especially chaotic. So what does all this mean for your personal financial future? First, understand that cash isn't coming back. The shift to digital money is essentially irreversible, so position yourself accordingly by becoming comfortable with digital payment systems and understanding their privacy implications. Second, recognize that the financial institutions you rely on today may not be the dominant players tomorrow. Banks might become less important as tech platforms absorb more financial functions. Be willing to adapt to new providers and platforms as they emerge. Third, diversification becomes even more critical in an uncertain monetary environment. Don't keep all your assets in a single currency or a single country's financial system if you can avoid it. Fourth, stay informed about these developments because they're accelerating. Financial changes that would have taken decades are now unfolding in years. The more you understand about digital currencies, changing payment systems, and shifting geopolitical dynamics, the better you can position yourself to adapt. Finally, engage politically with these issues because the decisions being made now about digital currency design, privacy protections, and financial system architecture will affect your life for decades. These aren't technical issues for experts to decide behind closed doors. They're fundamental questions about freedom, privacy, and power that deserve broad public input. Money is being reinvented right now. That's not hyperbole or clickbait. It's the reality of the moment we're living through. The question isn't whether you'll be affected by these changes. You will be. The question is whether you'll understand them well enough to navigate the new financial era successfully, or whether you'll be caught unprepared as the ground shifts beneath your feet. The choice is yours. I want to hear your perspective on this. Are you excited about digital currencies, or does the idea of fully traceable money concern you? Do you think cash will completely disappear in your lifetime? Drop your thoughts in the comments below. And if you found this video valuable, hit that like button and subscribe to the channel so you don't miss the rest of this series as we dive deeper into each aspect of this financial transformation. Now, let's explore what's really happening to money.